This table shows income from interest-earning assets. Every year, they report their average yield earned. That number 2 years ago was this, 1.9%. Last year, it more than quadrupled to 8.9%. And in the latest full year, average yield on domestic interest-earning assets was in the double digits, 11%, meaning that Bancolombia was earning more than 10 billion Colombian pesos just from domestic interbank borrowings. If we zoom out and add together everything that they charge interest on, the yield is still in the double digits, 10.9%, and interest income is over 37 trillion Colombian pesos, generated from over 343 trillion in average banking balance. The American depository shares on the New York Stock Exchange haven't really budged throughout this whole last year. We can see very recently price has broken out of an established channel, but that channel was already settling around the lower end of the analyst target range. But here at Sage Seeds Capital, we are interested in this Medellin-based company. What if we analyze this opportunity like business owners? What if we gain perspective from the annual report? That is exactly what we're going to do today. In direct contrast to what Wall Street analysts have been downgrading, I'm pretty hopeful we're going to see them be absolutely wrong. Here's a disclaimer for you.
This video is intended for educational purposes. Opinions made by me or the Sage Seeds AI are not investment advice.
For any bank, I go to the balance sheet immediately, and I want to calculate a high-level ratio that tells me how efficient the assets of this bank are being managed. Specifically, I want total assets divided by total liabilities to be as close to 1.1 as possible without being less than 1.1, because otherwise it could be getting a little aggressive and risky. Bancolombia is at a 1.128. Not only am I happy with that, I'm pretty happy with that. So now let's go to the income statement. Like most banking companies, the income statement is broken up into interest income and then non-interest income. Here they call it fees and commissions income. However, it's this total interest on financial instruments that has beyond doubled in just the last 2 years. This is where the change is happening in the bank. And this isn't just any tiny bank. This is one of the largest, if not the largest, hybrid consumer commercial bank in the Republic of Colombia, which is itself one of the major economies on the continent of South America. So where's this 36 trillion in interest income coming from when it's broken down into sections? Well, the annual report provides 5 different categories of interest income. Everything is growing except small business loans, which is roughly flat. But the ones that are really growing, the ones that are really growing, is the commercial financial instruments. We're going to zoom in onto the commercial interest loans. Hopefully the annual report gives us more details about how we should think about this as owners. Here is the breakdown of that commercial loan portfolio. The first table provided in a note to the financial statements is a table called the maturity of loans. And focusing just on the commercial section, we now see that the commercial category has itself 3 different divisions within it: corporate loans, small to medium enterprise loans, and all other. I'm going to take us way to the right to look at the total column so that we can understand in our head that small to medium enterprise loans are actually just a tiny sliver of the overall commercial loan portfolio. More than half of all the loans are what are called corporate loans, and a big chunk is actually classified as others, meaning we don't really know exactly what's going in there, even though it is clearly significant. Now, looking at these 4 columns, this maturity table, and looking at that bottom row, which says the total value in that maturity period, what I have done is turn this into ratios. So 22 trillion divided by this 40 trillion, 4 trillion divided by this 40 trillion, 13 trillion divided by this 40 trillion for every single column. I'm doing it in my head. And what I learn is that the balance between others and corporate as the maturity extends is actually swinging towards the others section. Probably the easier way to see that is to look at in 1 year or less, 13.7 trillion divided by 40 is going to be less than this 13.7 trillion divided by a lower number. Since the value of others is staying the same between these 2 maturity periods, but the total commercial loan value is decreasing, that's probably the most straightforward way to see that the others division of commercial loans is becoming more and more important over time. That's the trend. And so absolutely, we need to hope that they have more information about what is actually in others and why is it different than corporate or SME, small to medium enterprises. We would not be good owners if we didn't know what that was about. And it isn't until way near the end of the annual report, in a note called Loans and Financial Leases Collateral, a note that, as far as I can tell, is more focused about the collateral question, which isn't really our question right now, but also a note that provides a lot more detail about the makeup of the commercial loan portfolio due to dividing up the loan values according to the nature of the collateral. Now remember, within commercial, we saw corporate division, the SME, small to medium enterprise division, and the others division. This isn't going to give us 100% that translation, but given that I'm pretty aware of how banking typically is divided up, I'm going to do my best shot at telling us what looks interesting on here, which of these categories might be the bulk of the explanation for the others division. So real estate and residential, real estate, these three first rows, all about real estate, that makes sense. That typically is the bulk of what companies are taking loans out for in the first place. These next three, letters of credit, security deposits, and guarantee funds, typically all increase the larger your commercial company becomes, but they very much would be either in corporate or SME. Then we have a very mysterious row with the hyphen not applicable symbol for every single column. Sovereign of the nation. That very much fits the bill of what could be in the others category for sure. And so of the loans that do have collateral, the only explanation we have is another other category or sovereign of the nation. This is a quite unusual row to see in a banking company. So let's keep pulling at this thread because I feel like we're about to discover something very, very interesting that could explain everything we're seeing so far. And so luckily, we're looking at risk exposure by credit rating. Suffice it to say that the only reason I'm bringing up this table right now is because they have sovereign risk. This row revealing to us an exact value of what their credit risk is to sovereign. This is not the total value of their loans to sovereign entities, but it's their calculation of maximum exposure. But it could give us a proportional understanding because the total value of credit risk that they're taking on, or they believe they're taking on, is 27.5 trillion, 7.5 trillion of that coming from sovereign risk. That's a 25 to 27, 28% fraction. So we're looking at more than a quarter, but less than 3/10 of all of their credit risk exposure is sovereign risk. Said differently, sovereign risk is the second largest credit risk exposure that they have by their own admission, meaning that these sovereign loans very much could be the bulk of that others division in the commercial category of loans, because these aren't just a couple of one-off loans that they're including for completeness. Their sovereign loan portfolio is multiple times more risky than their otherwise second largest credit risk exposure, which would be the AA plus corporate loans. It doesn't tell us exact numbers. It gives us this lens of credit risk, which is not really the same as the loan value. And I want to know more about what types of governments they're loaning to. Luckily, way at the beginning of the annual report now, I mean, here you can see page 9. We skipped over all of this at the beginning, but now we're heading back. There's a risk factor called Summary of Risks Relating to the Bank's Business. Many risks listed here, but I'm particularly interested in this bullet point. The bank has significant exposure to sovereign risk. And then luckily, they say it, although you can see it's a little bit hidden. The way they word this makes me confident that this is the full list of countries they are loaning to. They are loaning especially to Colombia, the United States, El Salvador, Panama, and Guatemala. 5 countries receiving loans from Bancolombia. And because we followed this all the way from the top level of the income statement, what I think we're piecing together here is that Bancolombia is seeing its interest income double, triple, quadruple in recent years, not exclusively because of these sovereign loans, but in large part to sovereign loans to 5 countries in the Western Hemisphere: Colombia, US, El Salvador, Panama, and Guatemala. And this makes more and more sense the longer I sit with this annual report. Also in the risk factors, there is a whole section of the risk factors dedicated to these 5 clients. Risk factors relating to Colombia and other countries where the bank operates. Now, all of these countries and all of the world, largely speaking, is going through a bout of inflation. You might have heard about this. I'd be very surprised if you haven't heard about inflation and are watching this video, to be frank. But so what does inflation mean? Isn't that the million-dollar question on a lot of people's minds in the last couple of years? Well, I'm not about to answer it. Sorry, I think it's way too complicated for me to just answer that. But I can tell you one thing it means. I can tell you one thing it means for Bancolombia specifically and for potential owners of Bancolombia. It means that American credit agencies, such as Standard & Poor's, which I'm about to read this paragraph to you in a second, these agencies, which provide sovereign credit ratings that are used all over the globe and especially are used by Bancolombia to price its sovereign loans. Well, in January 2024, Standard & Poor's revised Colombia's sovereign credit rating from stable to negative. Now, the reason that Standard & Poor's gives is low levels of public and private investment that could affect medium-term growth capacity. Now, that's a very macroeconomic statement, but I actually studied macroeconomics before looking at these annual reports. I can tell you that the majority of macroeconomic models aren't particularly designed for inflationary environments. Most macroeconomic models actually greatly prefer stable monetary environment. That's not just an opinion. That is written into the assumptions of most of these foundational macroeconomic models. Now, I don't know the exact model Standard & Poor's is using. In fact, they will keep that to themselves, but I doubt it's deviating so much from the foundational solo growth model. And the key assumption of your medium-term growth capacity, which they're saying right here, the calculation for that depends on the assumption that if your country is going through inflation, that inflation is only affecting you and every other country still has a stable monetary market. That's the theory. In reality, every country is going through inflation at the same time. Now, I don't know much, but I do know that most macroeconomic models are inappropriately used in an environment where everyone is going through inflation at the same time. And so the simplest version of this is, if my inflation goes from 2% to 10%, that has a real shock on the economy. But if you're talking about my sovereign credit rating, you have to compare me to all the other potential sovereign entities. And so there is no looking at my country in a bubble. All the alternative countries are also having their inflation go from 2 to 10%. And now everyone has 10% inflation at the same time, then saying that I'm a riskier country to loan to may be true, but what does that matter when everyone's riskier to loan to at the same time and roughly to the same amount? And that's what I believe, just from my contextual knowledge, that's what I believe is going on here. Standard & Poor's very much doesn't care about making loans to sovereign entities. What they care about is having credit ratings that look like they're reacting to the situation and news as news evolves. From their perspective, I say is absolutely doing what they're paid to do. They're lowering the credit rating for Colombia. That raises the interest rate that Bancolombia and other regional banks can charge Colombia. And so Bancolombia immediately receives more interest income because Standard & Poor's lowered its credit rating. But the credit rating is not actually directly tied to the credit risk in this environment that we've been in for several years now, when every other country around it is going through the exact same thing at the exact same time. And so that one sentence led to that whole explanation. I do apologize, but I think it's important to realize that this one decision by an American credit rating agency may be detached from credit risk and may be the full explanation for why the interest margins are getting fat and fat really, really quickly. Next sentence, though, I like even more as a potential owner. In the next 24 months, there could be another downgrade in Colombia's sovereign rating if the government does not boost productive investment or control public finances. Now, that is very specific to Colombia, but given everything I just told you, my whole little theory of what is going on here, in my opinion, let's scroll down to the other countries that Bancolombia operates in. El Salvador also continues to face medium-term challenges. Guatemala is facing short-term risk, not medium-term risk, while the other two countries we're having problems mainly related to inflation. This short-term risk is talking about a political risk, which is not the same as inflation. Sure, I'm pretty sure Guatemala also has inflation as well, but that's not the main risk. There's a bigger risk for Guatemala, so fair enough. One of the 5 customers is legitimately more risky because of some political situation. Moving on, in Panama, we also see the same medium-term risk factor here. However, a little bit lower, they do also call out climate phenomenons, specifically El Nino, which is kind of a constant risk in Panama. Pretty much every few years, there could be a very bad storm that has real negative impact on the economy. Now, to Bancolombia's credit, I think they're doing a great job of really mentioning all the main clients they have in their others commercial division. These 2 paragraphs are where they kind of start to explain why they're still lending to these countries anyway. Recent global geopolitical fragmentation has resulted and may continue to result in a decrease of capital flows towards countries with emerging economies. Now, since this is a bank writing this sentence, you should be aware that banks don't run away from capital flows necessarily. If there is less capital flowing towards a country, that just means they can charge higher prices. Same thing as if a hot dog vendor told you that hot dog vendors were no longer going outside of this one specific stadium. Some hot dog vendors might say, well, that sounds risky, I'm going to stay away. But other hot dog vendors could say, okay, now it's more worth it for me to go to that stadium because there's less competition. In the second paragraph, meanwhile, the global context of economic deceleration and persistently high interest rates, despite expectations of a decrease in 2024, has created an environment where financial stress and the high reactivity of capital flows to emerging economies can keep financial stress elevated. As a result, it is reasonable to expect that debt service payments in government spending budgets will continue to be high from a historical perspective. That's the hot dog metaphor I just shared, but with the words of banking. Whenever you're going to see in the news, probably increasingly see in the news, that the US debt payments have never been higher, and same for Colombia, same for El Salvador, Panama, Guatemala. All these countries are paying more in government debt interest than they ever have before, and Bancolombia is getting a slice of that pie every time you see it in the news. Just remember that. This combination of low economic growth and, although decreasing, still high interest rates represents a short-term risk inherent in the economic cycle these countries are experiencing. And so let's pull it way back to the balance sheet, and start thinking about this in a digestion mentality. Let's start thinking about the worst case scenario here. 5 sovereign entity customers making up a big old 25 to 30% roughly of this 253 trillion in loans to customers. I mean, that could at the high end represent about 60 trillion in loans that Bancolombia has made to these sovereign entities. And those loans are really, really profitable right now, maybe in the future, but they also represent with them very complicated and real macroeconomic risks. And so returning to the income statement now, if Bancolombia is accepting these risks, on the actual credit risk table that they prepared, it was only about 7.5 trillion that they believed was the actual risk. So they estimate that they could actually get out of these loans and only take about a 10 to 15% hit. Well, that's just their expectation. Let's look at the hard numbers of what has happened in the recent past. Interest income, which is where we now know that those 5 loans to sovereign entities are existing. Well, the income on that has almost tripled in just the last 2 years. It went up roughly 70% in just the last year. A big chunk of that 70% increase was because of the downgrade of Colombia in credit risk rating. Now, these are big numbers. 70% just isn't a high growth rate. 70% is a very high growth rate for a large, mature bank. And Bancolombia really is a large bank. And a conservative bank too. I'm now at the cash flow statement. One of the largest negative costs is 7.5 trillion that is being reserved as a credit impairment charge. Despite that, they received more than 19 trillion in Colombian pesos in the last year, significantly more than tripling what they generated last year. This is what the Sage Seeds capital model almost surely was picking up on when it filtered this and presented this to me as a video idea. You gotta wonder how bad could the macroeconomic situation be for this specific bank is being so well monetized already that just last year they covered almost a third of the entire doomsday Armageddon scenario and just reacting decently well to this situation of inflation persisting everywhere in the Americas. So I'm trying to figure out the worst case scenario here. That worst case scenario looks to me like a complete collapse of 5 America's countries. I think we would have more problems than the Bancolombia charge-offs if that were to happen, to be honest. And so I very much doubt that Bancolombia will always be making double-digit margins in their income business, but they seem to be legitimately making these margins off of the trends in government debt spending. And frankly, that's just good banking. They are making sure these governments have access to the money they need right now, despite the situation becoming increasingly fragile since the pandemic for many of these countries. And they're doing it in a way that doesn't really magnify the risks that they're taking on to any outrageous level. Well, that's about as far as I'm going to be able to take this video. I need a break, although it was very fun. I'm going to put up the SafeSeeds Artificial Intelligence Value Score relative to the market and industry medians. I shared that graph in my last video on GameSquare Holdings. Please let me know if this is properly pushing the idea of just how potentially undervalued these companies I cover are. I am continuing to share extreme valuation situations as they come up, as I'm able to identify them, because these are the more interesting annual reports that I'm going to be able to find. And ultimately, this channel is about getting everyone comfortable with looking at these documents, with talking about these documents and analyzing these documents as potential business owners. I don't want people to get sucked into the investment advice that is so commonly shared on these platforms, these social media platforms, and then have a bad experience and then wonder for the rest of their life if all of it is some conspiracy theory. It's really not. I genuinely believe financial markets have never been freer pretty much everywhere in the world, as long as you remember to treat them as a financial owner, owning a business that you reasonably understand and sticking with it as a long-term investor, as long as you still believe in what the business's undervaluation is.